In the second quarter, capital markets assets performed much as they did in the first quarter, up. Indeed, world and U.S. equity markets were up around 5%. Global credit markets continued to do very well. High-grade bonds were up, as were REITs and commodities. In fact, this is the first time that for the first half of the year, all of these assets have demonstrated positive returns in over 2 decades. But among them, the one in most question is U.S. Treasuries and why yields are lower today than they were when we came into the year. Well, one of the reasons most often cited is the weaker recent growth. But the truth is, if you look here, yields have been below growth for some time, in fact, a few years. And remember, we expect growth to continue to improve. Remember the themes of moderate improving global growth, low levels of global inflation, and continued accommodative central bank policy. But we are seeing divergence within that policy. For example, in the United Kingdom, improving growth and falling unemployment have led Carney to suggest that maybe the Bank of England would be the first major central bank to tighten rates as early as the end of this year. But their neighbors in the Eurozone have actually cut rates recently in the second quarter and added more stimulus measures as Draghi is focused on very low levels of inflation and divergence within those low levels of inflation. In Asia, there are a couple of policy tightropes being walked. There are questions about whether Japanese growth will continue to do well or fade as the VAT tax has been increased. We're a little bit above consensus in site growth surveys, as well as improving unemployment metrics, but there are questions. There's the absence of wage growth and also structural reforms still to be implemented, so we'll be watching that. In China, we actually expect growth to be pretty solid, as China balances the notion of reform of economic policy with some inflationary measures they've taken more recently. We expect growth to be a little over 7%, a little bit higher if there's more reflation, a little bit weaker if there's more of a reform push, but we expect no hard landing and pretty solid growth. But the real country in question is the United States, so let's cut to the chase. I'd like to focus on improving jobs and continued improvement in jobs for some time now. Whether or not you look at the unemployment rate or the underemployment rate, things continue to get better, and the Fed has acknowledged this. The unemployment rate is down to 6.1, which is skirting with the Fed's definition of normal employment. And while there's a lot of pretty good economic data in the U.S., I can point to 3 that really matter. First, improving consumer sentiment. Second, continued expansion within the manufacturing sector. And finally, even housing, which ticked down in the winter, has ticked up, and other data surrounding housing have been pretty solid. So then why the question of Treasury yields, and why are they so low? Because they are so low. Well, look, there are questions around growth. Geopolitical concerns are still there, and Fed policy matters a great deal, what they say and what they do. And they've said they'll keep rates low for some time, and they keep buying Treasuries. Many institutions around the world are buying Treasuries, and they own almost 2/3 when taken together. And when they go shopping for yields, those yields are pretty low worldwide, so the U.S. is actually pretty solid compared to much of the rest of the world's offerings. And that's true whether you're an individual investor or a pension fund or insurance company. So when I put all this together, what does it mean for rates? Much as what we've said before, we expect the path to be low and slow. This is the summary of economic projections, otherwise known as the Fed's dot chart. And when you put together their central tendency, it's low and slow. The market agrees and is perhaps a little bit more benign. So what does that mean for you as an investor? The same advice we've been talking about for interest rate exposure for a while. Be global. If there are divergent yields in the world and divergent policies, there's divergent returns, so take advantage of that. And global is true in credit as well. I'm often asked, what is your best credit investment idea? And the answer is diversification. There's a world of investments out there for you by sector, but it gets even larger if I expand that to the universe of issuers. So take advantage of those, and it ranges from lower yielding, lower risk to higher yielding, higher risk alternatives. So let's bring it back together to global, where we started. As we finish up, always remember that we'll suggest that you globalize your portfolio and take advantage of countries and sectors around the world. The second piece of advice, be balanced. Use interest rate and credit risk and find that balance within your personal portfolio. And finally, while we see opportunities in the world, don't reach for yield. Play proper defense. It's low volatility and a lot of yield seekers, so we need to be smart about the way we do this. As we move through the rate rising cycle, stay invested and stay alert. And as always, thanks for joining, and I'll see you next quarter.